You run one of the more interesting, innovative funds that are out there. You run a whole family of funds, but particularly you run the Ark Genomic Revolution ETF, ARKJ. That's at a new high today, which targets companies in the genomics industry. And I was saying that you and I have talked many times, and over again, you've stressed the fact that tech in any form, whether it is medical in nature or banking in nature or industrial in nature, is transforming industries. We see that again today with the Moderna news and the announcement how it's moving the markets. Can you address that disruptive innovation, which is the heart of what your company is really all about?
Yes, I think and with the new technologies, the combination and convergence of DNA sequencing, artificial intelligence, and CRISPR gene editing, we're on the threshold of curing diseases. First human trials for gene editing started last year. I think we're going to get a lot of good news this year. And as far as the vaccines, we don't own Moderna. We own a company called Arcturus, and it's shot up to the #1 position in ARKG because it too has an mRNA vaccine, just like Moderna. We think both companies are in a fine position. Arcturus has a different delivery system that we think might be more effective, but there is so much room out there for these vaccines that we think a number of companies are going to find good success there.
Cathie, I want to come back and talk more about your other funds out there. But Jay, let me also chat with you for a moment here. You also have funds in your family that are involved in disruptive technologies. You have a robot ETF. You got a cloud computing ETF. The robot is BOTZ. Cloud computing, CLOU. Tell us a little bit about them and how, what kind of inflows or outflows are you seeing there? Is the interest still there, given how important disruptive technologies have been this year?
Absolutely. You know, investors are recognizing that disruptive technology is not really harmed by what we're seeing during COVID-19. They're actually some of the biggest beneficiaries. You know, so if we look at the cloud computing ETF, CLOU, it's holding companies that are facilitating video conferencing. It's holding companies that are facilitating governments communicating with their local constituents about emergency response, or companies communicating with their customers, all through software, through the internet, through these different types of cloud infrastructure. And that is just how the world is working during this stay-at-home environment. So we're seeing a lot of interest in cloud and robotics right now, and cloud in particular. Cloud ETFs have brought in over $1 billion year to date, with most of that money coming in just in April. So investors certainly realize that cloud computing has become really the key to the economy right now.
Yeah, and Cathie, you run the next generation internet, I don't have it here, but ARKW, I think it is, which is pretty much along the same themes. This is all, and what's interesting about what you're doing, Cathie, is it's very actively managed, and you make a very big point of the active management parts. So for something like next generation internet ETF, what goes into deciding what the weightings are? It's not an index. You're picking the stocks here. How do you determine what you like and don't like?
Well, we have top-down modeling, bottom-up modeling, and then an overlay, a 6-metric scoring system that is very important to innovation, starting with a visionary management, moats or barriers to entry, market share leadership, execution, thesis, risk, and valuation. And our stock positions line up pretty well with the composite of those scores. So generally, that's how we work it.
Okay, so it's a focused methodology that you're using, right?
Yes.
You're not. It's not in an old. It's a sort of a screen. I'm trying to. It's a scientific methodology you're using here.
Well, yeah, there's some art here as well. We generally start a position in genomics. We'll start it at 50 basis points, or in the other funds, 100. Our highest positions, I can buy up to 10% position in any one fund, and then let it run. We'll let it run to 12 or 13%, at which point we'll take profits. I think active in ETFs and active in any wrapper, frankly, is very useful for driving alpha in our case relative to not managing actively. And I'll just give you a good case in point. Tesla, if you look at Tesla in the year 2018 and take away the performance of the stock, it was a roller coaster generally throughout the year, and we were trading regularly around the volatility. If you just isolate the trading activity, our trading activity in Tesla, what you would have found is 175 basis points contribution to performance. And remember, 2018 was a down year. We had an up year, and I think one of the important reasons is we trade around the volatility. If Tesla is going down because some hedge fund or negative analyst is saying something that seems really awful, we have a pretty good handle given our research on that stock, and we'll be buying into it unless it's a big surprise to us. And on the contrary, when we feel like analysts are hyperventilating about a stock, and including Tesla, when there were takeover rumors of it, helped by Elon Musk himself, we naturally just take profits because we know we're going to get another opportunity associated with controversy to buy the stock lower. And just one last point. So
there's the ARK part. Oh.
Yeah, just one last point. We get a lot of questions about how can you be so positive on Tesla and be selling it? Well, I sold it just in the way I described, but it never lost the #1 position in our funds. If we had not taken profits in its ride up from 178 to 900 or nearly 1,000, it would have been nearly 20, maybe over 20% of the fund. That would not be wise portfolio management. We like to control our position sizes as I described.
Yeah, that's a good point. I mean, there is also the art part, but there is a point where 20% is certainly too much.